As we mentioned in the previous lecture, we need to take into account some type of time differentiation anytime a firm wants to undertake some type of investment, because they have some type of cost outlay today, but they're not going to see the sort of benefits or revenues of that investment until much later on. And in order to compare the future benefits with the present cost, we're going to use the present value approach. So it's used to compare investments with different returns and different costs. So it basically accounts for time. It involves discounting, and discounting just says that money received today is worth a lot more than money received in the future. So if anyone ever gives you a choice of $100 today or $100 a year from now, you should always take the money today, because there are things that you can do with that money. You can go ahead and invest it, get some type of return. There is no guarantee that you'll get the $100 1 year from today or later on. So you always want to take money if it is in your hands. In the present value approach, there are a lot of different formulas that are going to be attached with this. We take a look at annuities, the general present value, the future stream of value, the rate of return approach. These are all things that you're going to be seeing a little bit more specifically in your finance classes as well, but we'll just take a very general look at them in this section. So interest rates are going to be very important whenever we take a look at these present value sort of formulas. So when interest rates are high, firms are going to find fewer worthwhile investment opportunities. Remember, high interest rates, they're borrowing money at very high interest rates. That increases their cost. So that's not something that they necessarily like. And when interest rates are low, more investments become attractive because the cost of borrowing money has gone down. So the very first formula that we can go ahead and take a look at using the present value approach is actually a unique one called an annuity. So let's go ahead and see what annuities are all about. So annuities. And annuities are very unique and very special because there's actually not some type of specific time period that's attached with annuities. An annuity is a financial instrument. So if you wanted to go ahead and invest in these annuities, you could absolutely do so today. These are financial instruments that pays the bearer, and bearer here just means whoever wants to go ahead and buy the annuity or whoever owns the annuity itself. It's a financial instrument that pays the bearer a certain dollar amount, in perpetuity. In perpetuity, that's just a really fancy way of saying forever. And in terms of forever in the financial field, it typically means just for the life of the annuity holder. So until you die. So life of annuity holder. So once again, an annuity is a financial instrument that pays the bearer a certain dollar amount in perpetuity. And this dollar amount can be yearly, it can be monthly. It really depends on how the annuity contract is set up. And annuities are actually pretty sort of significant financial instruments. They're kind of popular because you generate a certain amount of income. You know exactly how much income you're going to be getting for every single time period. They do generate a lot of income for financial sort of advisors. So there's a lot of fees that you're going to have to be paying out, but it gives you a little bit of stability if you ever want to go ahead and invest in them. And in order to calculate out the value of an annuity, we have a formula for that. So annuity formula. We have three variables here. We have the present value, which is what the annuity is worth today. That's going to be equal to the annual income. And the annual income, we're just sort of simplifying this on an annual basis, how much income you're going to get from holding the annuity on an annual basis, on a yearly basis, and that's going to be divided by the interest rate. There you go. Very simple formula for the annuity in order to see what the fair market value of an annuity is going to be. So suppose that I give you these specific numbers right here. So suppose that you actually have an annuity. So annuity, you hold an annuity for some reason, and the annuity gives you, say, $1,000 a year. So $1,000 a year, and the current interest rate on the market, based on the loanable funds market, is equal to 5%. So here you have an annuity. It pays you $1,000 every single year in perpetuity, and you can hold on to the annuity if you want to. That's absolutely fine. It'll pay you $1,000 every single year. But what happens if you actually want to go ahead and sell the annuity to someone else or sell the annuity to a company? There are a lot of companies that do that. You might have heard one on the commercials or television quite often. It's called J.G. Wentworth. It's my money and I need it now. They're basically talking to you about an annuity. If you need cash right now, you can go ahead and sell the annuity to J.G. Wentworth. But what would exactly be the fair market value of the annuity that you hold, and if you wanted to sell it to J.G. Wentworth? Well, go ahead and use the present value formula for the annuity. We have the present value, which equals the annual income, which is 1,000. And then when you divide it by the interest rate, you do want to put the interest rate into decimal form. Do not take it as a whole number or you'll get a very small number. So here, divide that 5%, move the decimal point over 2 places, so 0.05, and simply divide that, put it into your calculator, and the fair market value of your annuity is going to equal $20,000. So if you wanted to sell off this annuity to J.G. Wentworth, J.G. Wentworth would have to pay you $20,000. Or it's probably going to be something less than that because there's going to be fees involved with all of this. But if you need a cash infusion right now, you can absolutely go ahead and sell it to that company. And like we said, there are different ways to go ahead and approach the annuity as well. Suppose that you wanted to go ahead and buy an annuity that pays you $1,000 every single year. Then you would go to an annuity company or an insurance company or just a financial company and give them $20,000 in order to generate this type of income every single year, if 5% were the current interest rate. And annuities are actually one of the primary reasons why O.J. Simpson actually sort of resided in Florida. Because in Florida, if you get sued, your personal property can be taken, but you cannot be forced to sort of liquidate any amount of money that you have in your annuities. So O.J. Simpson, basically he put the vast majority of his income and net worth into annuities, and basically knowing that if he got sued, his assets could not be taken because the vast majority of his wealth were in annuities. So something, just a food for thought for you in terms of annuities here in Florida. If you want to protect yourself, protect your personal assets and your financial assets, you just want to go ahead and put it all into annuities. Even though it may not be the best thing for yourself in a financial case because it's not going to be generating as much money as you can get in terms of the stock market or other areas, but it is a decent way to protect yourself, and that's exactly what O.J. Simpson did quite a few years ago. So hopefully anytime you hear the J.G. Wentworth commercial on television, you have a structured settlement and you need cash now, call J.G. Wentworth 877-CASH-NOW. You'll think about this annuity formula and know exactly how it works. Once again, this is going to be a special case of the present value formula because it doesn't really take into account a very specific time period. It doesn't say 1 year, 2 years, 5 years. It's basically in perpetuity. If we wanted to go ahead and take a look at specific years, then that's where we'll go ahead and get to the more general present value formula, and we'll take a closer look at that in the next video.